Welcome to Flippening, the first and original podcast for full-time, professional, and institutional crypto investors. I'm your host, Clay Collins. Each week we discuss the cryptocurrency economy, new investment strategies for maximizing returns, and stories from the front lines of financial disruption. Go to flippening.com to join our newsletter for cryptocurrency investors and find out just why this podcast is called Flippening.
Clay Collins is the CEO of Nomics. All opinions expressed by Clay and podcast guests are solely their own opinion and do not reflect the opinion of Nomics or any other company. This podcast is for informational and entertainment purposes only and should not be relied upon as the basis for investment decisions.
Welcome to this conversation with Felix Feng, co-founder and CEO of Set, which makes TokenSets.com and governs the Set Protocol. I've been following TokenSets and the Set Protocol for about a year, but I recently started diving in a few weeks ago after reading a tweet from James Poole, who's the CTO of Tokensoft and also a Nomics investor and Nomics API user. Anyway, James wrote on his Twitter feed that TokenSets was his favorite DeFi project. So thanks to James for inspiring this interview. TokenSets is certainly one of my top 3 DeFi projects at the moment. Starting in April of 2019, TokenSets lets users invest in crypto assets via automated robo strategies or social trading strategies authored by experienced human traders. All are sortable by performance, which in some cases has been exceptional. I believe that TokenSets is one of the most exciting projects in DeFi right now. Our conversation is split into 4 chapters. Chapter 1 is an overview of the Set Protocol and TokenSets.com. Chapter 2 is a quick history of social trading. In Chapter 3, we'll learn how to get started with TokenSets both as a user and as a social trading set creator, taking fees and hopefully earning money for the people who invest in your set. Finally, in Chapter 4, we'll cover operations at Set and the company's plans for the future. The transcript and show notes for this episode are available at flippening.com/set. That's spelled S-E-T. We'll get to this episode in just a second, but before we get started, I'd like to pause for a moment to tell you that this episode is brought to you by the good folks at CryptoTrader.tax. Here's 4 things you should know about them. Number 1, CryptoTrader.tax automates the entire crypto tax reporting process and has partnered with the TurboTax team to bring cryptocurrency tax reporting to the mainstream. Number 2, CryptoTrader.tax offers a complete tax loss harvesting module to help investors figure out their greatest tax savings opportunities to reduce their taxable income. Number 3, CryptoTrader.tax supports all fiat currencies, meaning users from all over the world can use the platform to calculate their gains and losses in their home fiat currency. And finally, number 4, CryptoTrader.tax offers a suite for tax professionals to help them manage their cryptocurrency clients. While I'm not a CPA and I'm not qualified to provide tax advice, I should note that I personally advise my family to never just hand over their exchange history to a CPA. Instead, I encourage them to let CryptoTrader.tax analyze their trade histories, find the tax calculation method that's best optimized to save them money, and then submit summary documents to their accountant. This saves you from having to pay your accountant to do the tedious work of generating Form 8949 and other similar forms. Creating an account and importing your historical data is completely free. You only pay when you want to download your tax report for the year. Just tell them that Clay from the Flippening Podcast sent you to get a discount on your tax reports. So go to CryptoTrader.tax today and sign up. And again, let them know that Clay from the Flippening Podcast sent you so that they know that these ads are working. This episode is also brought to you by the good folks at Nexo.io. Here's a word from them. Nexo is the only lender offering instant crypto credit lines, which let you use digital assets as collateral to get cash in 45 fiat currencies and stablecoins. You might remember Nexo from episode 64, where we spoke with their co-founder, Antony Trenchev. If you haven't heard it, I highly recommend checking them out as it's one of our most popular episodes to date. And Nexo has a big announcement related to credit lines. Their annual interest rates for credit lines are now starting at just 5.9%, which may very well be the lowest borrowing rate in the entire industry. Nexo is also a strategic partner of exchanges, OTC desks, and crypto funds through its portfolio of structured financial products. Institutional counterparties can earn up to 8% annually on their idle stablecoins, enter into asset swap agreements, or directly borrow crypto. Individuals can also park their cash in stablecoins at Nexo's interest-earning account to get an annual return of 8%. What's more, interest is paid out daily, and you can add or withdraw funds at literally any time. So if you're looking to borrow, lend, or swap digital assets, Nexo is your go-to partner. Definitely explore Nexo.io, and if you're an institution, reach out to them at institutions@nexo.io. Finally, this episode is brought to you by the Nomics API and CSV data export service. If you need an enterprise-grade crypto market data API for your fund, smart contract, or app, or if you need historical CSV dumps of trading data or crypto market cap data from top exchanges or even obscure ones, then consider trying out the Nomics API or our historical data export service. Our cryptocurrency API enables programmatic access to clean, normalized, and gapless primary source trade data across a number of cryptocurrency exchanges. Instead of having to integrate with multiple exchange APIs of varying quality, you can get everything through one screaming fast fire hose. And if you'd like to order historical cryptocurrency market data as CSV exports from top exchanges, then email us at sales@nomics.com. Okay, back to our regularly scheduled program. Here's my conversation with Felix Feng, co-founder and CEO of Set Protocol. Enjoy. I'd love to hear a little bit about your background prior to Set Protocol. What were you up to and how did you fall down the crypto rabbit hole?
I was born and raised in the Bay Area, and I went to school at UC Berkeley. And during my last year there, in 2013, my friend was trading and mining Bitcoin at the time. And this was a period of time when Bitcoin went from $100 to $1,300. I became very curious and bought $1,000 of Bitcoin on Coinbase, and I probably sold it for a $10 profit. And in 2014, I studied abroad in Milan, and as I got deeper into the crypto rabbit hole, I decided to attend Bitcoin 2014, which was the annual Bitcoin conference at the time. And I got to see a number of the technical presentations by the core developers. I saw early stage companies such as Coinbase, and met some influential leaders like Charlie at the time. And I left that event thinking, wow, the technology underlying Bitcoin is going to transform the finance and legal industries the same way that the internet did for media and communication. So after that, I started buying Bitcoin, and it was when Bitcoin was around $600. And over the course of the next year and months, it actually went down to a low of 150. And I was thinking to myself, what am I doing in my life buying Bitcoin and being down 75 or 80%? But this is something I kept at. After I graduated, I worked in finance, and in 2015, I reached out to Paul V at Pantera Capital, and he took a meeting with me because there wasn't really that much happening in crypto at the time. And I had a coffee with him, and I wanted to do whatever I could to contribute, and I ended up helping him look at early stage companies at the time. So it was mostly exchanges, wallets, but we saw some interesting companies like Civic, Brave. I met like Juan Benet when he was still pitching IPFS before it was Filecoin.
Oh, very cool. Yeah.
And I helped some of the portfolio companies at the time. And I realized that I was spending a lot of my free time and my money in crypto, and really the next natural step was to spend all of my time. So in 2015, I was looking to join a crypto company, and there were two well-funded ones in the Silicon Valley at the time. There was Coinbase, and there was 21. I ended up joining 21, which was a Bitcoin mining company. It had built one of the first ASICs in the industry and had about 2% of the mining network. But due to increased competition of mining, particularly in China, and decreasing asset prices of crypto, I helped them make that transition from kind of running mining operations in US-based data centers to pivoting to a 21 Bitcoin computer or a Raspberry Pi developer product to Earn, which is a paid email service. So I kind of saw all of that, and afterwards, I ended up deciding afterwards it was 2016, and crypto was a little bit a boon to be in. Most people were focusing on the scaling debates, and it didn't seem like much progress was being made. So I took a hiatus from the industry and worked at a machine learning startup as a software engineer. But in 2017, Paul came and told me, hey, you need to pay attention to this thing called Ethereum. And I was mostly a Bitcoin maximalist at the time, so I wasn't paying attention to the nascent technology. But when I looked at the white paper, I looked at all the development that was happening and the community around it, I became bought in. And that was when I started converting some of my Bitcoin to Ethers when Ether was about $70. And I vividly remember doing that conversion on a Friday, and over the course of that weekend, it went from $70 to $150, and that marked the beginning of the bull market.
When you refer to Paul, is that Paul Veridicate?
Correct.
Yeah, okay, at Pantera. Okay, very cool.
So that marked the beginning of the bull market, and I was fascinated by all the new ideas and projects coming out, and I had been investing kind of in these projects through the ICOs as well. And the ones that were most fascinating to me were really the ones around decentralized trading and decentralized exchanges. So the 0x's, the Kybers, the AirSwaps of the world. And I ended up starting an angel syndicate called Turing Capital with a number of other investors and entrepreneurs. And we sourced and did a number of deals together. Along the way, I was also learning Solidity. I ended up attending a Consensus Academy, which was in its first cohort, where they had 1,500 applicants. They whittled it down to 150, and those people got to learn Solidity in a very structured manner. And I was one of the beneficiaries of it. And along the way, I actually went and attended ETH Waterloo, which is the first Ethereum hackathon. And I was originally planning to join a team that was working on Web3 and TypeScript. But on the plane ride there, I was thinking about what was missing. I was very fascinated about the decentralized exchange technology, but what really opened my mind was after I read Antonio's DYDX white paper. It helped me realize that you can build sophisticated financial products using smart contracts. So I thought about what was missing in the space and realized that no one was really building a fully decentralized index fund. There had been some other things like Prism, Shapeshift, there was Bitwise, but there wasn't anything fully decentralized. So I architected how to build that on a plane ride over, and by the time I was landed, I was so compelled by the idea that I ended up ditching my team and working on what became Set. And over that weekend, I ended up presenting to folks like Joe Lubin, like Will Warren of 0x, Linda Shea, and they thought it was a really cool idea. I ended up presenting to Consensus in a more formal setting where I presented to Joe and Jeremy Miller, and they actually kind of considered giving me an EIR, or Entrepreneur in Residence role, to work on this project. So I ended up turning them down, but eventually I started getting all my friends involved. So I created a GitHub and a Slack, and we started hacking and developing Set. And eventually we raised a seed round in March of 2018 from some really great Silicon Valley investors, including Craft Ventures, VY Capital, DFJ, among others. And we've been building out Set since.
I found that, even very flexible platforms, which it sounds like the Set protocol is, and what you're doing at TokenSets is also fairly flexible in terms of, sort of use cases and financial products that can be created with it. It's also really helpful to understand kind of what that singular use case was that got you to build it in the first place. And so it sounds like you're saying that initially the first instantiation of the Set protocol was for creating fully decentralized index funds. Is that correct?
Correct.
So let's transition to chapter 1, which is kind of an overview of what the Set protocol is and also what TokenSets is. I guess before we get too far into this, can you help us just differentiate between Set protocol and TokenSets? I know that they're related. I know how they're related, but would love to hear it sort of expressed by you in a way that the layman can understand.
In general, we're focused on essentially kind of helping users implement some sort of portfolio management strategy. Right now, of the $200 billion in market cap in crypto, about 60% or 120 billion of that is held by retail investors. And most of them do not implement some sort of portfolio management strategy. And, as a result, they have missed out on billions of dollars of opportunity, or experienced $1 billion of losses, particularly when the crypto cycles are so volatile. And what we've built at Set is an Ethereum-based protocol for automated trading. And this protocol is a set of smart contracts that is intended to be utilized by developers, by financial institutions, by exchanges, and by other folks who want to build services for the end user, which is the investor or the trader. So Set Protocol is that underlying infrastructure, and TokenSets is the first product that is built on top of the protocol. Just to give you a little bit of overview of the protocol itself, what we've enabled is essentially the creation of a trading strategy that is tokenized. So each is represented as an ERC20 token. It is similar to an ETF in that it can be listed on exchange. You can trade it in your wallet. It also has the creation and redemption mechanisms that are similar to an ETF product. That means that every single set is fully collateralized, which means that everything that the set represents, which is this abstract token, is held in a smart contract called the vault. And in addition to that, these sets can be periodically rebalanced based on some sort of predefined rules or through the discretion of a third party. And these rebalancing acts happen through a Dutch auction, which is an auction where the price starts high and goes down over time. And finally, this protocol inherits all the benefits of DeFi, which is that it's accessible, it's 24/7, it's global, it's permissionless and available to everyone in the world. It's transparent, like every single trade and transaction can be tracked on the blockchain. And it's interoperable, which means this protocol serves as a building block in which other people can build on top of. And it's totally open source and auditable, whereas traditional financial services may be a closed or walled garden, if you will. Like I mentioned, TokenSets is really the first product that is built on top of Set. And we have two types of products. We have essentially the Robo Sets and the social trading sets. And that's what we've built today. And that's how most people understand this set ecosystem today, is through this product called TokenSets.
Let's talk a little bit about underlying technologies. So it was interesting to hear that you started out playing around with Bitcoin. That was sort of your entry into the space. Paul came by and said, hey, you should check out Ethereum. And you were investing prior to Ethereum, but you weren't building prior to Ethereum. And that's something that I've heard quite a bit, that smart, intelligent people who had a desire to create in the space enjoyed a lot of the theories and concepts behind Bitcoin, but they really didn't start, flexing their creative muscles and building until they found Ethereum, because the community, the opportunity, the sort of the abilities that smart contracts or the opportunities that smart contracts open up just sort of engendered creativity inside of them and sort of, got them to build when they weren't before. Do you think you'd be a builder in this space if it weren't for Ethereum?
For me, the technology underlying crypto, always felt like, it was something that we could build upon to reinvent the existing financial system. I see that the existing financial system is extremely broken and archaic. We live in a world that is 24/7, that's global, and that's powered by the internet. We can interact with anybody through a text message, and someone on the other side can interact with us directly as well. The information around the world is accessible by all. And that really isn't how the financial system is today, despite the internet. We have some fintech companies like Stripe, Plaid, PayPal, and what they've really done is build on the existing broken rails, which are 9 to 5, Monday to Friday. They're expensive and slow, and just applied a layer of lipstick on a pig, if you will. So we think that's not the way the future is going to be. Instead, what we believe is that entire financial system needs to get rebuilt from the bottom up, like from first principles. It needs to be global, internet first. It needs to be inclusive of everybody. And that's really what we're trying to achieve with DeFi. And Bitcoin, as I see it, is the first piece of technology that demonstrates that you can have money that has all these properties, right? 24/7, global, available to everyone in the world. And what DeFi is, and decentralized finance, is really extending that to be able to do more, right? So instead of just holding a currency and transacting it, you should be able to lend it. You should be able to borrow. You should be able to trade derivatives. You should be able to swap with somebody else. You should be able to implement some sort of asset management strategy. And what we're finding on Ethereum, at least, is that a lot of this underlying infrastructure is getting created and built. And this is uniquely enabled by smart contract platforms in which Ethereum has really kind of pioneered and invented it. With Bitcoin, it just has been too limiting with the scripting language to be able to offer the breadth and the ease of development for someone to build something. So Ethereum has really proven that out. And as a result, we saw very primitive technologies like MakerDAO get built on top of it. Now we've seen kind of money markets like Compound. We've seen derivative products like DYDX come out, and we have an explosion of activity that's happening in DeFi, and this is happening extremely quickly. This is open source, so we're seeing an immense amount of remixing happening. For example, there's a dozen different versions of DAI today. There's R DAI, there's Y DAI, there's A DAI, and people are taking these technologies, adding their own little twist on top of it, and we're seeing more innovation on DeFi now in terms of financial products than we have ever seen in a while in the traditional markets. And the dynamic that we really see at play here is the innovator's dilemma, where most traditional institutions and most traditional investors are used to a value proposition and a feature set that the current existing system is able to provide. And DeFi's feature set is very limited and doesn't really meet the need of the sophisticated user. But what we're seeing is that the improvement of DeFi is happening exponentially. Like DeFi wasn't even live a year and a half ago, but it's made so much progress and has recently hit $1 billion in total assets locked. And over time, as we see these improvements and because of the open source nature of this technology, things are going to move extremely quickly. And at some point, we're going to hit parity with existing financial products. And after that, our products will be order of magnitude better than what exists today. So that's kind of what I see shifting over time. And I think that we will need to make improvements in the underlying infrastructure. Ethereum does need to scale. Like, we're going to need to make the onboarding process a lot easier, a lot more seamless. We're going to need to add more assets onto Ethereum, but these are things that are going to improve incessantly. And we're just taking one foot in front of the other.
One of the things that got me really delving into what you're doing at TokenSets is a tweet that I saw from James Poole, who's the co-founder of Tokensoft. And he sent out a tweet that said, "I think TokenSets is my favorite DeFi project right now." And then he refers to ETH-MACOAPY, which basically works like this. If the ETH price goes below the 20-day moving average, it rebalances funds into CUSDC so you can get a yield. If the ETH price is above the average, it rebalances into ETH. I think that's a pretty cool strategy, and it looks like it's one that's been working. But let's touch on underlying technologies a little bit. So what is absolutely required for the Set protocol to work? I mean, obviously Ethereum is required. Is DAI required? Can you just walk us through the tech stack that's required to make Set protocol work?
Yeah, the moving average crossover set has been quite popular and performing really well. And most of the users who have been holding it are quite happy to have multiplied their Ether. In terms of the underlying technology that powers TokenSets, the first thing is just the underlying assets that are available. So each asset that is included in a set needs to be an ERC20 token. And some of these that we have today are wrapped Ether, DAI, USDC, compound versions of DAI and USDC, so CUSDC and C DAI. We've included wrapped Bitcoin, which is an ERC20 representation of Bitcoin that is backed 1-to-1 in a custodian wallet. And we've also added Link as well. Firstly, it's the tokens need to exist. In addition to that, we need tokens that are liquid on Ethereum. They need to be supported by some sort of market maker or liquidity pool. So ideally, the underlying assets are listed on something like Kyber Network, Uniswap, or traded widely on 0x exchange. And there are a number of sophisticated market makers that can provide the liquidity underlying these tokens. In addition to that, to implement the strategies and to implement our Dutch auction, as we described earlier, we do need Oracle feeds or prices for these assets. So for Bitcoin and Ether, we actually work with MakerDAO to utilize their price oracles. For the Link USD kind of pricing, we have worked with Chainlink to provide the Link USD price. And for other oracles like the Compound token, or we actually built our own oracles, what we call meta oracles on top. So we'll take the underlying price and then get the exchange rate on the Compound smart contract and automatically compute the price of the C token. And another thing that's interesting that we built to power some of our strategies are essentially what we call these meta oracles. So for example, like we need to compute information such as moving average, right? So what we need to do is to track the price of Ether on a 24-hour cadence. And we do that using our own we have our own smart contract system that will kind of track these prices and track a history of daily price movements. And then we can compute like the moving average using that. The possibilities are really limitless, and we can combine these different indicators to create sophisticated strategies that power the Robo Sets today. So to summarize, like a few things that we need are, one, we need the underlying tokens, and we need them to be liquid. We need oracles as well, and that's really all the dependencies that we need that power the system today.
Let's dive a little bit deeper then on introducing token sets. So it looks like you've got a number of sets that are able to be created. There are robot sets, there are social trading sets, there are sets based on the activities of individual traders. Can you just give us a rundown of the various types of sets that exist and how they work? Maybe starting off with robot sets.
There are really kind of two categories of sets today. The Robo Sets are sets that are proprietary and have been created by the Set Protocol team. And some of these strategies are simple, like the index strategy. So we have a few sets, for example, where if you want to maintain a 50% allocation of wrapped Bitcoin and a 50% allocation of wrapped Ether, you can have that periodically rebalance, let's say on a monthly cadence. We have some other more sophisticated strategies that are where the rules of how the strategies are executed are predefined in smart contracts. And these are strategies that we have typically back-tested, we have developed, we have deployed, maintained, and marketed to kind of the general public. And one type of strategy is what we call the technical analysis strategy, which is using these indicators like the moving average to make a trade. And as you kind of described before, a moving average strategy works as follows, which is if the current Ether price goes above the moving average or the indicator, then you may rebalance or trade into Ether. If it goes below that, it would go against it. And it turns out that these strategies work extremely well in trending or volatile markets. And that's exactly what crypto is you have frequent bull and bear markets where you can take advantage of these opportunities. And ironically, most people in the industry believe that you should just hold or hodl your crypto. But if you've hodled long enough, you would have realized that there's significant times when crypto is overbought and there's many times where it's oversold, and most people are kicking themselves thinking like, wow, I should be smart enough to be able to take advantage of these opportunities. But most people can't because they either don't have access to some sort of like crypto hedge fund that they can put their money in, or they're not sophisticated enough to do it themselves. It requires technical knowledge, it requires time and effort, which is really hard because crypto is 24/7 if you were to do it manually. Really the Robo Sets are kind of help automate this for the end user. And like I mentioned before, all these strategies we have today, we built ourselves, and we started opening it up to third parties to create sets on our platform. And that's really what social trading is you have these sets where the strategies are not created by a team, but by third parties. Some of these third parties are crypto hedge funds like Alpha Chain Capital or SW Capital. Some of them are professional traders like Aaron Kruger. And these are folks that have been able to amass significant amounts of capital into their sets. And they implement a wide variety of strategies. Some of them are also completely algorithmic, where they have built their own kind of trading systems and have connected that to the Ethereum smart contracts. On the other hand, you have some traders that do a semi-automated strategy where they look at indicators, but at the end of the day, they have discretion to override an indicator if they feel that it is not correct. So we have two types of kind of groups of strategies, which is the Robo Sets created by us and then third-party ones. And in our platform, on TokenSets, we are focused on getting the highest quality traders on our platform. Now, we have over 600 people who are kind of waitlisted who want to be social traders, but we've only really allowed kind of launch of 20 of them today. So we really focus on quality.
can a third party create a Robo Set, or are Robo Sets only created by you? Let's say there's an algorithmic trader and they want no sort of day-to-day control. It's all going to be run by the algorithm or the smart contract. They open source that. Can they submit something to Robo Sets, or are Robo Sets only created by you guys?
Robo Sets are currently created by us, and one of the main reasons is that the Robo Sets require extensive amounts of smart contract skill sets and technical abilities to be able to generate, right? You have to write Solidity code to implement these Robo Sets. You have to connect them to the oracles. You have to write deployment scripts to deploy them onto Ethereum. You need to verify the contracts once they're out there. And you need to run backend systems to constantly monitor and to be able to ping these Robo Sets to rebalance when needed. So it's an immense amount of work to do it. And most traders, they are very good at trading, but they're not necessarily programmers, or they haven't spent a significant amount of time investing in learning Solidity. We're the only ones that have built Robo Sets to date, but there are many algorithmic traders that have built their own systems that are non-smart contract based that submit trade signals into the existing social sets.
So, for a listener who's hearing this information and comes from the traditional financial world, maybe they've been an LP in a crypto index fund or a crypto hedge fund. Are there KYC, AML requirements? What kind of lockup is there? What kind of fees exist compared to 2 and 20? If you were going to create one of these sort of product comparison tables, how would this compare to, let's say, like Bitwise Investments Index Fund or other similar funds?
The first thing that you kind of want to lay out and think about is really like what types of asset management strategies are available for crypto, which ones are profitable, right? So, originally in 2017, it made a lot of sense to invest in an index fund of crypto products. And that's where we started. There was a proliferation of tokens, and any one token could have gone to the moon or 100x, and anything could have been the next Dentacoin. So it was smart to diversify across a large number of tokens. That's what we believe had product market fit back in 2017 and 2018. And we were building products that were trying to create a decentralized index fund. But over time, in 2019, 2020, we saw that the long tail of tokens became much less interesting, and everything consolidated back into the large caps, which is Bitcoin, Ether, and USD-based trading became very popular as well. So the product market fit shifted, and we realized that what worked extremely well in crypto was the quantitative strategies, the ones that used technical indicators and where people traded based on the different types of trends. So that's another type, and that's really where we started, because we see that it was the most profitable for the investors. 2, it was very difficult to implement for a retail trader. And our products, just to be clear, are for the retail users today, whereas traditional kind of crypto funds or even index funds are marketed towards institutions, right? So people who can put in hundreds of millions or billions of dollars into these asset classes. And the nice thing about our Robo Sets today is that they have no fees. So compared to something like a traditional hedge fund, which is 2 and 20, or a traditional index fund, which is 2%, right now the Robo Sets charge nothing. And what's really funny is that on a performance standpoint, have been doing a lot better than traditional index funds or crypto hedge funds even.
Hey, I wanted to pause for a second to let you know that this episode of the Flippening Podcast is brought to you by our longtime and trusted partner, Nexo. As someone who personally uses Nexo, I wanted to point out a few things that I especially like about their crypto-backed loans. First, when the price of your collateral grows, so does your credit line. Let's say that you borrow against your Bitcoin when each is worth $5,000, but over the course of your loan, the price grows to $10,000 per Bitcoin. This means that the size of your credit line just doubled as well. I personally haven't seen anyone else doing this. A second thing that I really like about Nexo is that you only pay interest on the amount that you borrow. I've seen Nexo competitors require you to take out loans and force you to withdraw the entire amount. With Nexo, you get a credit line and can withdraw the funds that you need and not a cent more, paying them back whenever you want, with interest assessed daily. Again, this isn't something that I've seen any other providers do. The final aspect of Nexo I'd like to highlight is that they give you the ability to borrow against a basket of crypto assets. For example, if you post BTC, ETH, and BNB as collateral to your Nexo account, the Nexo Oracle calculates the real-time market value of those assets and adjusts your credit line accordingly. Again, to my knowledge, other providers in this space only allow you to borrow against one asset per loan. This episode is also brought to you by CryptoTrader.tax. Without them, we wouldn't be able to provide this content free of charge. CryptoTrader.tax makes the excruciating task of reporting your cryptocurrency gains and losses a breeze. Indeed, sorting through transaction records from your exchanges and reporting each trade in US dollar terms is not how most crypto investors want to spend a weekend. CryptoTrader.tax is a software platform that automates the entire cryptocurrency tax reporting process. It's basically like TurboTax for cryptocurrency investors. All you have to do is connect your exchanges and import your trade history into the platform. CryptoTrader.tax will do all of the number crunching and spit out your auto-filled tax reports with a click of a button. Simply give these generated tax forms to your accountant or even import them into your preferred tax filing software like TurboTax or TaxAct. You can join more than 10,000 crypto investors who are automating their crypto tax reporting with CryptoTrader.tax today. Creating an account and importing your historical data is completely free. You only pay when you want to download your tax report for the year. Just tell them that Clay from the Flippening podcast sent you. That lets them know that this advertising is working, and it also gets you a discount on your tax reports. Finally, this episode is brought to you by the startup that produces it, Nomics.com. Nomics is a crypto market cap website and aggregator going head-to-head with CoinMarketCap. We stand as a transparent alternative to many of the sketchy market cap websites out there. We won't name names, but I think you know who we're referring to. Anyway, if you haven't been to Nomics.com in a while, I encourage you to visit our website. We offer transparent volume statistics for nearly every cryptocurrency and crypto exchange in the space, and I believe we have the only credible crypto exchange index in the space as of this recording. If you're sick of scammy ads, bad design, and manipulated data provided by companies whose founders hide from public view, then check us out at nomics.com. All right, back to Felix.
With our Robo Sets, some of them, the best ones, are actually up 70% against the US dollar. So this has been something that has worked extremely well to help not only preserve users' capital during extreme downturns, but help them amplify the amount of return they get when the markets go up. But over time, we will start introducing fees. For example, with the social trading sets, like the traders have discretion over what type of fees they can charge. So they can charge an entry fee or a typical hedge fund type of compensation structure, whether it's a subscription fee similar to a management fee or a profit-based fee, which is similar to carry. They can set this on their own, and some of them have set it to a 0% management and entry fee, but maybe with a 10% profit-based fee. Some of them are more evened out in terms of type of fee structure they add. This is something that really democratizes the kind of hedge fund products to everyone else, whereas most people don't have access to many of these other types of products you have offered. In addition, it makes it extremely accessible because it's available to everyone in the world. 2, it does not require KYC AML. All of our assets right now are focused on spot commodities. So the traders don't need to be like a registered investment advisor or commodity trade advisor, which is typically required for securities and registered commodity interests. In addition to that, because we're not offering securities, we don't need to be a registered investment advisor, a broker dealer as well. So those are some kind of limitations that we have because we built a non-custodial protocol. We don't have any capability to hold on to or move people's funds on their behalf. So those are a few things that are really powerful that distinguish us from some other traditional products. And it turns out that the return profile of these products have been far superior to many traditional products, index funds, even crypto funds, and even many venture funds have failed to do better than our Robo Sets.
What about lockup? Let's say someone puts their money in. What kind of restrictions exist around taking that money out?
There are no lockups. Your funds you can take them out at any point in time.
That's absolutely amazing. This has to be the way of the future. I mean, this has to be the way things are going. I've wanted to see something like what you're doing for quite some time, and I agree with James. This is my favorite DeFi project right now. Okay, so let's say you are someone who's been selected to create a social trading set. What is it like for these people? Is there a sort of a friendly UI that allows them to make decisions and apply those decisions? Do they have to have a developer on their team? What goes into running one of these sets if you are a person not at Set Protocol who's been selected to do this?
We've made the process of updating a set extremely easy and initiating rebalances extremely easy. We launched with a user interface where you as a trader can kind of view the existing position of the set. And then we have this really beautiful interface where you can drag and between kind of an asset pair and decide what to rebalance and when to rebalance the set. So for example, if you started with a set that was 100% Ether, you can rebalance it into 100% USDC. And then what you do is you would need to connect your Ethereum wallet, whether it's MetaMask or your Ledger or some sort of dApp browser that you use. And then you just submit an Ethereum transaction after you click a button. It's as simple as that. And that will automatically kick off a Dutch auction in which, it would auction off the collateral, the Ether for the USDC. And that happens under hood. So the trader only has to worry about what to rebalance into and when, and nothing about the liquidity of the underlying and like what pricing you get when you do a rebalance. And what's really cool about being a trader on Set is that you get 24/7 direct access to our entire team. So we set up a Telegram channel with the trader and the team, and we have constant dialogue and communication with all of our traders. So we get really close with all of the folks.
So they don't have to worry about custody. They don't have to worry about trade execution. They don't have to worry about any of that stuff. They can just focus on generating returns. I also like how the UI shows how much the creator has personally put into a given set. So it lets you know how much skin they have in the game. I find that useful to have. So thanks for including that. I think that's especially important. What risks are there other than the market going down? Let's say there's a category of risks that have nothing to do with market movements and just making incorrect bets. What other risks might exist? Security risks, tech stack risks, liquidity risks. If you were advising a highly technical person in your family who you cared a lot about kind of investing in this space and they didn't know a lot about crypto, but they were technical, what would you tell them and what would you advise them about when it comes to risks outside of just number go down?
Ironically, number go down is what our Robo Sets want, because that's actually where the strategy's profit is, that it saves you from when those periods of time happen. And it rebound, like typically when number goes down, it rebalances into USD, and then you would actually buy back at a much lower price. And as a result, you would have multiplied or earned more Ether because of the price drop. So our strategies thrive in times of huge drops and huge gains. In terms of the types of risks, there are really two categories. One is smart contract or security risk, and then two is economic security and risks. So with the smart contract risk, that really is about the security of the smart contract's solidity code. So has the code been written properly? Does it have bugs? Are there errors? Are there vulnerabilities? And luckily, over time, the entire Ethereum community has started taking security extremely seriously, particularly after the 2016 DAO and parity hacks. So it is best practice today to have your smart contracts audited by multiple auditors. And that's what we've done with Set is when we initially launched the protocol back in the early 2019, we had 3 sets of auditors look at our smart contracts. We've used the best in the industry. We used Trail of Bits. We had Chain Security look at it, and we had Jonathan Haas from Brahma as well. And any new code that we write, we also have every single line of code audited too. So for example, when we launched like the version 2 of our rebalancing set tokens system, we had a PeckShield, which is a Chinese-based auditing firm, look at our smart contracts. And they are actually the ones that found some of the vulnerabilities in MakerDAO's MCD system ahead of their launch. In addition to that, any smaller pieces of code, we've actually worked with boutique agencies to look at our code ahead of any deployments. So we feel very confident about the security of our code, and particularly given that our protocol has been live for so long and there hasn't been any issues. The second type of potential issue really is around economic kind of issues. Like one thing is that we do rely on MakerDAO oracles. So if those oracles are out of sync or not updated or manipulated, that may cause issues with the pricing of the auctions or with making a rebalance when you should not have made a rebalance. So those are some issues in addition to that. And I think that's the other thing is really economic in nature is the way the liquidity of the underlying tokens. We're very careful about the types of tokens that are listed because we would need market makers that are hooked into our platform before we launch something. And we're very careful about the sizes of the rebalances. So for example, like if we have a rebalance that goes through that is about $3 million of size, we need, a certain number of market makers that can provide $3 million of liquidity for that rebalance to ensure that the slippage levels are acceptable or low. And if there are not those number of market makers online, then the slippage level can be high. Like you wouldn't want to lose 5% on a trade when going from Ether to USDC. You'd be okay with something like less than 1%.
Hey, this is Clay cutting in from the editor's booth to explain a bit more about slippage. Slippage is simply the difference between the expected price of a trade and the price when a trade is executed. In Felix's example, a person swapping ETH for USDC expects a certain amount of USDC to be available at the current spot price. But if enough USDC isn't available at current spot prices, then some of the ETH will need to be sold for the next best price and then the next best price after that until the order is filled, resulting in a higher average USDC price than might have originally been quoted. So that's slippage. All right, back to the show.
That's something that we have to manage as well, and of course also presents a risk.
So when it comes to, kind of managing these large block trades, as TokenSets gets larger and larger, more users, more capital, these are going to be larger and larger trades, kind of happening at predictable times. What kind of manual control do you have over that? Can you sort of pause rebalancing or wait for that to execute when you've sort of lined up the proper counterparties? Is there a manual component to this, or how do you manage risk around that, around slippage in block trades?
Right now, like I mentioned before, we implement a Dutch auction for our block trades. So essentially, our largest rebalances to date have been about a little bit more than $2 million. So $2 million get auctioned all at once. It's an auction where the price starts high. So let's say like 1% above fair value, and it hits fair value over time, which is when the value of the assets being deposited equals that of those being withdrawn. And after that, there's a spread for market makers. And how our auctions work is that the price improves in favor of the market maker by 1% every 10 minutes. So imagine that, after one minute, it would be 0.1% improvement and so on and so forth. Doing a block trade of $2 million is like fine because there are market makers who may have millions of dollars on hand that can take down these auctions at sufficient liquidity. But imagine if we're doing a $50 million block trade, we would need a lot more liquidity and most folks do not have that much capital on hand. So some of the scaling kind of things that we're doing are trying to break up these block trades. So typically, if you have a large hedge fund, you will typically use a more sophisticated execution algorithm like time-weighted average price, which is TWAP, or something like VWAP, percentage of volume, or you would use something like Iceberg. And the idea is that you're splitting up like a $50 million trade into 10 $5 million chunks. So these are some of the improvements that we're making on our liquidation mechanisms to allow us to scale and handle much larger rebalances. And these are things that traditional hedge funds and ETFs implement as well.
I'd love to dig into that a little bit more. So is this something that happens on chain and is facilitated by the Set Protocol and it happens at specific times? So there's actually OTC desks or market makers or people who are, willing to be counterparties on these trades sitting around waiting for this auction to start, and then they start bidding using some UI provided by the protocol. Like, how does it actually go down?
In terms of when the auction begins, it is determined by the Robo Set strategy or whenever a social trader decides to perform a rebalance.
Okay.
And that immediately kicks off the Dutch auction. And we have a network of market makers and liquidity providers who are connected to take down these auctions. Some of them have built fully automated systems where they do an on-chain arbitrage to take down some of these auctions and provide liquidity. This is typically what happens for many of our smaller auctions, is that they are taken down automatically through these systems. We also have other types of market makers that treat these auctions as OTC trades. So they would put, whenever they anticipate a rebalance happening, they'll load up their Ethereum wallets with $1 million of Ether. And then when the auction begins, they go onto Set Protocol, like TokenSets UI, and then they bid on the rebalance when the price becomes favorable enough for them to take it down. So and then some of them have a mix where they have a semi-automated system and they have the ability to override. And typically, these market makers will float themselves using Binance or Coinbase centralized exchanges, or they have their own other liquidity pools that they pull liquidity from. But we have a whole kind of spectrum of market makers that are able to connect and take these down. And we expect that the breadth of market makers increase as we are able to facilitate much more volume over time.
There's different portals on the website for different types of users. Obviously, for people that are looking to buy and sell these sets, kind of the average consumer investor that would use this, there's a portal for them to buy and sell. Then there's, I imagine, another portal for the traders that are running these social trading sets where they can initiate rebalances and things like that. So are you saying that there's another part of this website where market makers, liquidity providers, OTC desks, et cetera, can log in to participate in these Dutch auctions? Does that happen through the website or through some other UI?
Correct. It does happen through this website. If you actually scroll all the way to the bottom of the site, there's a button called on the footer, there's something called rebalances. And that's really the UI part of the site for the market makers. And we've made it, and you don't need to log in. Like, you just need to connect your MetaMask account or your ledger, and you can get started. Anyone can provide liquidity on these auctions.
Okay, got it. So it's not exactly like a two-sided marketplace, but the whole system does require liquidity providers to be participating. And I imagine that was a fair amount of work to build this community from the ground up to allow this to happen. Is that correct?
Correct.
I'm learning a lot as I go through this. It's super fascinating. I love how nearly every part of this has been democratized. It sounds like the only thing that really requires some sort of validation or vetting is to be a trader. I think that's probably a good thing. So if there are no trading fees right now, how do you guys make money? Like, what are your incentives?
In terms of our incentives, the idea is that in the future, we will charge some sort of entry or exit fee. So when someone mints a set or exits, we'll have some sort of 30 or 50 basis point fee. And we'll be making money off of the volume of people going in and out of these sets. In the future, we might add some sort of subscription fee to the Robo Sets. So the longer that you put your capital into the Robo Sets, you get charged for that, similar to the compensation structure of like an ETF or index fund, which typically has an expense ratio. So those are the ways that we'll be monetizing on TokenSets.
Let's transition to the next chapter, which is really about the prehistory for what you're doing. So index funds have been around for a long time. ETFs have been around for a long time. What about social trading? Like, from a product perspective, where did you draw your inspiration for social trading? Has this ever been done really at any kind of meaningful scale in the traditional financial world prior to DeFi?
Most people in the United States don't know about it because there's no really great examples of social trading. But social trading has been around for over a decade now. It started in the Forex trading universe, and the company that has really became the leader in social trading is one called Etoro. Etoro is pretty big now, and they've been at the peak probably been facilitating $500 billion of volume a year from their copy trading features. So essentially, Etoro is the biggest, but there's a number of other players like Zulu Trade or Collective 2, Amongo as well, a German player. So social trading has been a development, and many people in Europe think it's the future of finance, whereas traditional hedge funds and asset management is very opaque, very inaccessible. Social trading has proved itself to be a lot more accessible, open to more people. The data is all transparent. And there's a lot of academic research that's happening on the social trading side, particularly from academic institutions in Europe. So social trading is only starting to become a thing in the United States. For example, Etoro launched crypto social trading in March of 2019. Robinhood is exploring adding social features onto their platform. And we believe that social trading is what going to resonate with kind of the millennial and the Gen Zs the most. So that gives us a lot of confidence that the industry, not just crypto, but broader in finance, is moving in the direction of embracing social trading.
Has eToro always been crypto only, or were they doing this prior to crypto?
They were doing this prior to crypto. Crypto was a newer phenomenon. They started as a brokerage that was trading traditional assets like commodities, ETFs, stocks, derivatives, and crypto was just another addition to the mix.
Let's move on to Chapter 3, how to get started on TokenSets, both as a user and as a social trading set creator. Let's take folks through a step-by-step walkthrough. If someone, let's say they find a Robo Set, for example, or a social trading set that they would like to get involved with, what do they need to get started? What do they need before they can purchase a set?
You don't need much to get started with getting a set. Some people log in with, MetaMask or Ledger. If they use a dApp browser like Coinbase Wallet or IMToken, they can use that as well. But for those who don't use any of those solutions, you can just sign up with your phone number, or you can sign in with your email. And if you do that, it'll automatically create a hosted Ethereum wallet for you. From there, if you already have some crypto on exchange like Binance or Coinbase, we prompt you to send it in through our onboarding flow. Or if you don't even have any crypto, you can actually pay via like a debit or credit card. So it's super easy to get started. And in the future, we will actually be planning on building a native fiat on-ramp support. So not only can you pay with debit or credit card, but you can even connect your bank account and go directly from money in your bank into a set, kind of all in one single transaction. But if you're not starting with fiat, you can pay with a variety of tokens. You can pay with Ether, you can pay with USDC, with wrapped Bitcoin, any asset that we support, you can pay with. And once you have got started with account, you can explore the different types of sets we have available. You can look at the Robo Sets. You can read the descriptions. You can see the history of performance. You can read and explore the back tests that we've done for Robo Sets. And once you're comfortable with the set, then you can acquire one. That's super easy. You click the buy button, you put how much you want, and then you just click buy, and you're able to get one in just 2 clicks. And it's the same thing for social trading, where you explore the traders, you read the descriptions of their sets, and then when you're ready to make a purchase, you simply click buy, and it happens, once you submit an Ethereum transaction, it gets mined and you own the set today. And selling is just as easy. Once you want to, kind of sell the set into the underlying asset, then you do the inverse process. And like I mentioned before, there's no kind of lockup periods or anything like that. Like you can buy a set 1 minute. If you kind of have regrets, then you can immediately return it. So it's pretty seamless.
I like the phone number feature there, and the ability to do this without having to touch things like MetaMask. Can you buy a fraction of a set, or do you need to buy an integer multiple of a set?
Absolutely. One of the beauties of crypto in general is that you don't have to buy a specific multiple of a set. Like you can buy a fraction of a set. You can buy 1/100th, 1,000th. You can buy a millicent of a set. There are no restrictions on the minimums.
Let's talk about creating sets for social traders. So you mentioned that there is a long wait list. So there's a lot of people who want to be producing sets. Is that something that most people can realistically think about doing in the short term, or do you intend for this to always be kind of like a highly curated process that isn't going to involve thousands upon thousands of traders? Is it realistic for a very talented trader? Let's say there's a kid in India who's been trading out of internet cafes and getting, 1,000% plus returns year after year, bull and bear markets, just crushing it. They can show the history of all their trades, and they come to you and say, hey, I'd really like to be a trader. I think I can create a lot of returns for your users. Is it realistic to think that they'd be able to get an account set up anytime soon?
Yeah, if you have someone like that and they're able to kind of show us the track record and they're thinking around their strategies coherently, then we love to have them on board. With Set, like really like the way we think about kind of these strategies is it's kind of like content. And and a good analogy is like, for video content, there's companies like YouTube where you have a number of different, anybody can create kind of content and upload them. And you have the other model, which is more like Netflix, where they've curated the content and created some themselves. As we research social trading, it turns out that more than 70% of users can't make a return for their followers net of fees. So we would call those, I guess, unskilled traders. And what we want to do is ensure that our platform is high quality and that these traders can, in fact, help users kind of earn a return using their strategy. Where we want to focus on the highest quality traders and help them become successful initially. So that's where we love to see people who have really great finance backgrounds. We love to see people who are running their own crypto funds already. We love to see people who have been posting lots of content on Twitter or TradingView to show kind of all the work they've done that kind of purports that they can earn the returns for their traders. And typically these traders are the ones who may find it a hassle to set up their own fund. Typically you have to spend tens of thousands of dollars if you want to get something set up in the Cayman Islands. In addition to that, you have to go out and raise capital on your own, which is a hassle. But with social trading, we make that process extremely simple, right? To get set up as a set, it's a matter of a smart contract transaction and talking to us. And you're able to garner capital from anyone in the world, and it's a very seamless process. So what we found is that there are a number of sophisticated actors like hedge funds that would very much prefer to use something like Set versus set up a much more traditional entity. In addition, they have the flexibility to focus on driving kind of alpha, and they have all the fee structures that they're familiar with. In addition, like we talked before, they don't need to worry about kind of finding liquidity or trade execution. That is something that's just inherent in kind of the protocol itself, and in which it would try to get you the best price possible. Those are some things you don't have to worry about, which are great benefits to being a trader on Set.
There are a few people I know that I think are excellent traders that have gone to create funds, and they've got to worry about kind of like feeder corporations and stuff in the Caymans and in Delaware, blah, 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 and the LP docs and everything that goes into administering a fund. And they end up really just kind of hating themselves. They end up not being very good at providing audited financials to the fund manager, even though they have the potential to create really amazing returns. They just kind of turn dead inside at the thought and of having to do all this stuff that had nothing to do with why they wanted to start a fund in the first place. And it seems like those types of people would make a really good fit for your social trading program. They don't have to worry about custody. They don't have to worry about settlement. They don't have to worry about any of the legal things. Like they can just focus entirely on generating returns, and your platform takes care of the rest. That seems like a no-brainer for those people, and especially if they've got a large, maybe YouTube following or Twitter following, a large personal brand. It seems like that kind of person might be an asset if they were to kind of come to your platform and say, I'm going to start something up here and I'm going to tell my audience about it. Seems like a slam dunk.
Absolutely.
Let's talk about, decentralization and trust. Let's say, God forbid, the entire Set Protocol team were on a flight somewhere, and that flight, again, God forbid, knock on wood, all that stuff, but the whole flight goes into the ocean. What happens with all this capital and with all these funds? Is anything not recoverable?
No, if God forbid, knock on wood, it never doesn't happen. But if we disappear, nothing really happens. People are still able to issue and redeem sets. The only thing that is different is that I guess no additional upgrades or changes can be made with the protocol if the governance were gone. So that's one of the big things that we continue to strive for, is to continue to improve and upgrade the protocol so that it's able to cater to more traders. It's able to cater to more users. It's able to, different types of asset management strategies can be added. Different types of assets can be supported. So these are all things that improvements continue to be done. And we believe in the concept of progressive decentralization. So even though today it is governed via like a multi-sig, which is owned by the team, over time, we believe that this is something that should serve as public infrastructure, and that over time it will be the community that governs kind of this protocol. So that's something that we're working towards over time, so that if there were one team in the future that was hit by where the plane blew up or something, then the protocol will continue running and continue improving without that centralized team.
And even the website, if the website were to go down, a third party could construct a website that would allow people to continue trading.
The beauty of the Set protocol is that if the website goes down, someone else can recreate it. Even right now, like other people are actually going to be building front end interfaces for Set on top of the Set protocol. It just happens that TokenSets is the first one. And all of the underlying sets and the permissions and all that stuff can be transported elsewhere. Now, some of the information that we do have is a convenience. Like we keep track of the traders' names, and we have information about we've archived like their trading history and some of the reasoning behind their trades, etc. Those are things that make the UI really nice. But all the underlying data that you really need is really all on the Ethereum blockchain.
Let's transition to Chapter 4, Sets, Operations, and Plans for the Future. Can you tell us about location, team size, anything you can tell us about active users, revenue, whatever metrics you're willing to share about your company would be helpful for this section.
We are a team that's predominantly based out of San Francisco. We're a team of 8. We have a few folks that work remote, like Anthony Sassano, who is based out of Melbourne. TokenSets today is now serving thousands of users kind of around the world. And we have garnered recently up to $9 million of kind of capital in our sets. And we've done almost $60 million of buy, sell, and rebalance volume since inception. So we've been making a ton of progress lately, and we've seen some of our highest volume numbers in recent days. So the word of mouth around kind of the set and sets and their value proposition is really spreading now. So we're seeing kind of immense amount of growth today, and we're pretty excited about kind of the future ahead of us. As we continue to improve our offering, we're able to onboard more really great traders in addition to building out our ecosystem. We would hope in the future that TokenSets ends up becoming the vanguard of crypto, and that other people may build kind of the BlackRock using kind of the Set protocol.
Let's talk finally about the future in terms of upcoming features and product roadmap. What are you most excited about?
I'm really excited to, one, be expanding the scope of the types of strategies that we're able to offer. So right now our strategies are very much catering towards the quantitative type of strategies where you're doing momentum trading. And we're excited to be increasing kind of the trade frequency of these strategies. So today we do swing trading, which is maybe like every few weeks a rebalance happens. We want to enable some trading behavior such as trading every day or trading every hour or so. So that will improve as we're able to bring more liquidity on board as Ethereum infrastructure improves. We're excited about adding more assets into our ecosystem to enable a greater breadth of strategies as well. So today we have all the spot commodities like Bitcoin, Ether, USD, but we'd be excited to add synthetic assets. So enabling people all around the world, for example, to invest in a synthetic kind of S&P 500. We're also very excited to add long and short tokens. So not only can you go kind of long and sell into USD, you're able to profit from going leverage long or short on your positions, which opens up a whole new kind of world for traders. We're also excited about making some improvements to our platform. For example, we love to help grow by implementing an affiliate program. So if someone like you or a YouTuber were to share Set, they can share a link with their subscribers, and if their users ended up buying a Set, some of the fee that goes to the company would be shared with the affiliate or the refer. And we're very excited about some usability improvements as well. As the number of sets on our platform grows, we want to make it easier to search, to filter, and to onboard new users. We're excited about adding a fiat on-ramp like directly onto TokenSets as well. So those are some of the things that we're doing that we hope will continue to drive additional kind of volume growth on our platform and drive additional AUM growth on our platform too.
Felix, last question. It's the question I ask everyone. If you were able to wave a magic wand over the entire crypto space and altruistically and instantly make something happen for the space, what would you do?
I would want all of the infighting in crypto to end. I want all the Bitcoin maximalists and all the Ethereum maximalists and all the other coins to stop arguing with one another and focus on building the future. I think our community is really great. It's just we spend a lot of time fighting each other versus moving kind of all in the same direction. I think if we just did that, we'd be making 5x more progress than we are today.
That concludes my conversation with Felix Feng, co-founder and CEO of Set Protocol. I hope you enjoyed it. Before you go, I want to invite you to subscribe to our fully customizable daily crypto newsletter. It's the first of its kind in the industry. You choose the delivery time and the cryptocurrencies that you want price updates and news about, and we'll ship you tailored pricing data and market news 7 days a week. It's a great way to cut through the noise and drill down to the crypto market info that matters most to you. To subscribe, go to news.nomics.com. Again, that's news.nomics.com. All right, that's it for this week. Stay tuned for next week's episode. Until then, take care. Bye. That's it for this week. To sign up for our free crypto investing newsletter, listen to other episodes, or get the show notes from this episode, please visit flippening.com. I also invite you to check out the startup that funds this podcast, Nomics, spelled Nomics, at nomics.com. Finally, if you got value from the show, the biggest thing you can do to help us out is to leave a 5-star review with some comments and feedback on iTunes, Stitcher, or wherever you listen to podcasts. Thanks for listening, and see you next week.